All right, everybody, welcome back. Really quick, just doing a little bit of a trade review on CRM. Right now, we're looking at a picture that I just took. I annotated everything, just kind of making it pretty. We kind of call this, putting lipstick on a pig. But the trade was entered into yesterday. I had an idea that perhaps CRM would stay below this risk zone. So let's just kind of zoom in here a little bit. So you can see the risk zone that I had marked was this consolidation in price. I had an idea that we could trade for a short duration with the 20 period moving average, perhaps providing some resistance against price, meaning it would protect us a little bit if price tried to continue this upward rally that it had been in. You can see we had a little bit of a pennant shape, right? That little wedge out of a bear pennant, and it had broke out of the bear pennant to the upside, meaning the bear pennant was failing, but it still looked like it would struggle to get into this red zone, this risk zone. So I sold the 265 call. I bought the 270 call. That put us in a call credit spread, and we collected $146 for that trade. It's going to expire in 24 days, 25 when I put it on. So consider it a short duration trade. And, I usually round everything just to make it really simple. I round up in my head for this to $1.50, and I want to take about 50% profit. So I'm looking to get out by buying it back at around 75 cents. If I sold to open for $1.50, then I want to buy it back around 75 cents. And that's my 50% target. It doesn't mean that I'm going to blindly hold it until I get to that target value. If the market makes me nervous, something that I see in SPY or QQQ, if it seems like tech is rallying, if it, news comes out on CRM, anything could adjust this to where I'm no longer comfortable with the risk and I close the trade down. Now, I don't want to do that, right? We don't want to respond that way in the market with that crazy phrase, well, you can't go wrong taking profits. That's a dangerous way to do business, because if I'm willing to risk, $350 here, then I need to make sure that I'm actually getting some return for that risk. And this trade does have 350 at risk. Now, I would not blindly sit there and lose the entire 350. And generally in a losing trade, I try to get out somewhere between 50% and 2/3 of the max loss. But again, if I'm willing to accept that kind of loss, I should be trying to target at least 50%. Now, one thing that would make me stay in this trade longer is if CRM really started to fall, right? So like right now, as long as CRM stays below that red zone, I'm in a winning trade. And if we just kind of continue to hover, here in this area, kind of migrating around down here, I'm going to close somewhere around that 50% mark. But if CRM was just to really start to fall, right? And I mean, just crazy, crazy dumping to the downside, I'm not really going to be interested in closing that trade down, right? Because now I'm really not feeling the risk. So, a good rule of thumb says we should be willing to close the trade somewhere around 50%, try to keep our consistency in our trading, but I don't do that blindly. And so if this market was to just really, really start to dump, I'm not going to close this. In fact, I would probably roll those calls down to get more credit and extend the trade, right? So just something to keep in mind. When I do my trade alerts, I generally put in, my profit targets to close, but that doesn't mean I always close there, especially if I see an opportunity to stay in longer. I rarely ever post those updates though, because it just gets too confusing for people. But this was the CRM trade. We'll just kind of zoom back out here a little bit. You can see that downward move in the market. I'm on a daily chart on a 3-month time frame. We had that gap down that was not connected to earnings. And then, a little bit of an island reversal play here where it gapped up, had a week sideways, and then dropped back down. That island reversal was what I was considering a good area for a risk zone. And the break-even calculation is the short leg on the call side, and then we add the credit collected. So my short leg is 265. We add $1.46. That gives me a 266.46 break even. As long as the market stays below that, the trade is winning. The longer it stays below it, generally speaking, the more of this credit I should generate profit on, right? So that's it. I appreciate your time, guys, and I look forward to seeing you at the next video.